Well, yes to all three. I mean, certainly valuations have been extended, particularly in the hottest parts of the market, like AI and technology. And those areas of the market not only were extended technically, but we also could see that we were getting some weaker news, right? So some of the disappointing news from, let's say, Tesla, from Alphabet, some of the news from NVIDIA here. We heard that Warren Buffett is lightening up his shares in Apple. And on top of that, we've got weakening U.S. economic data, although not disastrous by any means, but the jobs report, the manufacturing PMI, all pointing to a slowdown in the U.S. economy. Add geopolitical concerns and political concerns to all of that, and you get the market ripe for a sell-off in the middle of the doldrums of summer, where maybe there's usually less buying activity in the market. So all of that coming together to create a triple perfect storm for the market. That said,
right,
I don't think this is the environment where the Fed is likely to hold an emergency meeting and cut rates.
I wanted to ask you, so to be sure here, the data is consistent with a slowing economy, but one that is not falling off the cliff. And in terms of the Fed's reaction function, an intra-meeting, an emergency rate cut is not necessary, in your opinion, yes?
That is our view. You know, the Fed has certainly cut during emergencies in the past. The pandemic was an emergency, but, you know, slightly weaker job growth here, a dip in manufacturing in the summertime really doesn't constitute that for us. Remember that an emergency cut could worsen the sell-off of the dollar versus the yen, which is already part of this carry trade unwinding. So it may actually move the direction of risk off in the wrong direction.
But, Jeff, here's the thing, right? You're saying the Fed would only go intermeeting an emergency cut if there were something really extraordinarily negative to happen. But when you take a look at what the VIX did, and you know I was going to get to this, right? We nearly hit 70 overnight on the VIX before it halved that, so we're up at about 38 right now. But the last time we saw the VIX do that, above 65, was 2008, the financial crisis, and again 2020, the pandemic. What is the VIX telling you?
Yeah, well, the VIX is telling me that everyone was standing on one side of the boat and suddenly tried to go to the other side. But that doesn't mean we've got a problem with the financial system. On the bright side, there's little systemic risk in the banking sector to an unwinding of the carry trade this time around. The biggest yen carry trade unwind in the last 20 years was in 2008. But unlike in 2008, foreign bank borrowing in yen is now nearly non-existent. And that results in limited spillover to the financial system, something the Fed will be very, very attuned to.